With the Dow Jones Industrial Average hitting another all-time high today, how do we go bargain hunting? If you're looking for value, I think it makes a lot of sense to go hunting for yield. Yeah, right now the benchmark 10-year Treasury, even though interest rates have been going higher, still at 1.85%, which means dividend stocks are offering you the kind of income you can't really find anywhere else. And that's one reason why some of the best performers in the Dow have been stocks with bountiful yields. And it's why tonight we're going off the charts with the help of Dan Fitzpatrick, the terrific technician, who's the founder of Stock Market Mentor, as well as being my colleague at realmoney.com, where I blog, because it's going to highlight some of his winners. Now, I don't know if you remember this, but the last time we checked in with Fitzpatrick back in mid-September, he told us that Apple and Microsoft were ready to roar. A lot of people laughed. Microsoft's up nearly 5%, but Apple is up 17% since he made that call. So I said, I got to go back to Fitz and see what he's thinking. He nailed those two tech titans, and now he's recommending 3 Dow dividend stocks. Remember, if interest rates stop going higher, these are really going to be really terrific. First one, Dow Chemical. Second, Verizon. And third, Walgreens Boots Alliance, especially since we just learned the latter could, and I'm putting big quotes around that, soon be taken private. Although it would be an immense deal, and I want to be very careful recommending it on that basis. That's not why I like it and not why he likes it. But first, let's start with the daily chart of the broader Dow Jones Industrial Average, because Fitz likes what he's seeing right here. Right now, the Dow is breaking out from what is known as a symmetrical triangle pattern. It started when the index peaked back in July. Since then, it's been making a series of lower highs and higher lows, and this is called a classic continuation pattern, meaning that the Dow is merely resting before resuming its long march higher. Resting, 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 taking a nap, ZZZ, okay? Most securities tend to move in phases. You get a monster rally, followed by a consolidation phase. Traders take profits. Sooner or later, the supply of stock for sale is exhausted, and now demand results in another leg higher, meaning there's not enough overhead stock, so they come in, they buy, and that's how a stock moves up. Now, we're an index, and that's what the Dow's doing right now. Hey, when you get this kind of breakout, Fitzpatrick says you want to buy as early in the process as possible. What makes him so confident? For one thing, there's the volume. The Dow tends to break out. It tends to decline on weak volume and rally on strong volume, and that's a sign of increased buying activity. Plus, when you measure the July peak to the August lows, the Dow's recent range is 1,900 points. Okay, so you can see the August lows. You can see where it's done. Technicians like Fitzpatrick, all right, it's a good-looking chart, add that number to the old ceiling of resistance, giving them a measured move price target, which in this case could take the Dow to 2,900. Oh boy, that is an extremely bullish forecast, isn't it? But it makes sense to me now that we've taken the recession fears off the table and the Fed is very much our friend. That's nirvana. There's no reason why it can't go up. If the Dow Jones Industrial Average is ready to roar, which will its components of the components that we should get involved in? Which are the ones that could actually lead the charge? Now, this is where I differ with Fitz, but I'm going to give you what he says. It brings us back to the Dow dividend stocks. Walgreens Boots, Dow Chemical, and Verizon. So I want you to take a look at the daily chart. Let's start with Walgreens. Now, this is a company I have been very skeptical of. I've repeatedly told you I prefer CVS, which reports tomorrow, because it's got that Aetna business that I like so much. But last week, Walgreens reported a solid quarter, and today we learned that the company is, well, let's just say some people are saying it's thinking about taking itself private. And that sent the stock up 2.6%. Oh, and it still has a nearly 3% yield. So why does Fitzpatrick like this one? Okay, simple. Walgreens spent 7 months wallowing in a pretty tight trading range after a big breakdown in the spring. The 50-day moving average was basically flatlining. The 200-day moving average kept falling. Basically, the stock was building a base in the low mid-50s, and eventually everyone who was willing to sell at those levels had already bailed. And that's where we found ourselves yesterday when Walgreens broke out above $58. I saw that breakout. I said, what is that about? On heavy volume, look at the spike. With the technicals anticipating today's big news that the company might be taken private. Today, the stock continued explosive move higher. If Walgreens ends up being taken private, it would be the largest leveraged buyout in history. I say that as a potential negative, not positive, because that's a lot of money. And I have to believe that they would pay a meaningful premium versus where the stock's currently trading. Using the key moving average as a guide, Fitzpatrick sees a couple of important things happening here. First, the 50-day moving average is finally moving higher, and that's the red. Okay, you see that's ever so subtle, right? Which tells you we're at the beginning of a new uptrend. Second, the 200-day moving average is still trending lower. but Fitch says we'll likely get a bullish crossover within the next couple of weeks. And that's where the short-term 50-day moving average goes above the longer-term 200. That is a classic trajectory, okay, classic sign that the stock's on the mend, which is what we need to see. That's why technicians call this the golden cross. And if you see a golden cross occurring here or anywhere, well, I'd just say that you got to buy the stock hand over fist. Where's Walgreens headed? Fitzpatrick's betting the stock can go to 70 on this breakout, up above 14%, and that's not on a takeout from where it's currently trading, although it probably won't go there in a straight line. So again, this is fluff, I think, okay? So just discount that, and what you're seeing is the nice kind of upward trend that Fitch says we should buy. I don't want you to chase anything like this, though. All right, how about Dow Chemical? Now, here's one. After being spun up by Dow DuPont in April, the new Dow Chemical swiftly lost about a third of its market capitalization over the next 4 months. Stock bottomed at $40 in late August. That's when we really thought there was going to be a recession, right? And then finally the sellers just kind of ran out of merchandise. I mean, they were just done. Since then, Fitzpatrick points out that the major institutional money managers have been buying this one hand over fist. You can tell because it tends to rally on strong volume and decline on weak volume. He says, so this is weak volume, and that is strong volume. Meanwhile, Dow's 50-day moving average, it turned up when the stock broke out above its multi-month downtrend last month. As of today, it climbed all the way back to 54 and change. This is a really impressive move. It's gotten a bit overextended here, but he recommends buying Dow into any weakness, and I think there will be some. But the company is paying you a 5.5% yield just to wait for it to be able to make things better. It does trade, by the way, with oil, too. I think Dow's exactly the kind of stock you can buy when you realize that the risk of recession has been taken off the table. I wouldn't be surprised if it stalled here and that had more room to run. And I am kicking myself that we sold this one for the charitable trust, even though we ended up getting at good prices. But this thing is now a juggernaut, and it's a juggernaut because of the possibility that business is going to get better in this country. Finally, there's the daily chart of Verizon, which really doesn't fit well with Dow. This doesn't need business to be stronger, but get this. This spent the better part of a year, one full year, stuck at a trading range between the low 50s and the low 60s. Every time the stock hits 61, it gets overwhelmed with supply. Investors start ringing the register en masse. However, for nearly a year, Fitzpatrick noticed that Verizon's been making a series of higher lows, creating a flat triangle pattern. You can see this is the flat triangle pattern. And what happens is in a flat triangle pattern is it eventually breaks up to the upside. More recently, in the past couple of months, the stock's made a smaller flat triangle. That's this one right in here, okay, with the floor of the formation at roughly 59, all right, not far from where it's currently trading. Now, this is what's known as a fractal, where you have a small version of a pattern tucked inside a larger version of the pattern. And Fitch says fractal formations can be very powerful if you trade them correctly. Now, at these levels, Verizon's still stuck in jail between 61 ceiling and down here, at that 59 level. A lot of people feel it's really gotten boring. I don't care about that. You could buy it right here, but Fitch recommends waiting for a breakout above 61 because that's when you'll know that the leg is really going to be starting. From 61, he expects it'll be smooth sailing to $70 based on the length and depth of the consolidation pattern that Verizon is currently stuck in. You know me. I don't like to buy them high. I like to buy them low. Buy some right here. The bottom line, the charts as interpreted by Dan Fitzpatrick suggests that the Dow Jones Industrial Average has a lot more room to run, and he thinks it will be led by the dividend payers. Verizon, Dow Chemical, Walgreens Boots, a very contrary call. Oh, and if Walgreens is really taking private, I bet Fitzpatrick's $70 price target comes true even sooner than expected. But remember, we don't chase tips. We leave them for waiters. I'm saying this because I'm so afraid you're just going to buy it on a takeover basis. That's not why I'm doing this piece. Okay, much more Mad Money ahead. Calculation error. Sent Twilio stock tumbling. With the shares falling almost 13% over the past week alone, I got the CEO, and it is a hot seat, believe me, like the Jenkins hot seat on the side in the NFL. Then I'm telling you why it could be time to curb your enthusiasm when it comes to this market's rally and revealing what's really behind the move higher for some of the stocks, not these, and all your calls rapid fire. Tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? head to madmoney.cnbc.com.